Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, June 15th, 2021. You may not recognize the background that you see behind me. That's because I'm in an unfamiliar location, my office. Haven't been here in quite some time, over a year as it turns out. And it was interesting. I hadn't dealt with the Merritt Parkway during rush hour in some time. I hadn't remembered the fact that I actually forgot my pass and had to follow someone into the office, and not all my systems are up and running. And I suspect that actually as America and the world gets back into office mode, you may actually see a little dip in productivity. The economic statistics show that corporate productivity, in many cases, is higher throughout the work from home situation than it has been from going to the office. And if my limited sample, admittedly truly anecdotal, is any indication, today has been a fairly unproductive day relative to a normal work from home day. Instead of finishing, taking my coffee upstairs to where I work, I got in the car, drove, sat in some traffic, came upstairs, and found that some of the usernames and passwords had changed. And so here we are a little bit after 10 o'clock and still not really up and running in the way that I would have been prior to the pandemic or the way that I had been at home. Enough about me, though. What we're seeing today is a bit of a reaction to the higher than expected PPI numbers that came out this morning. We're taping this about 10:15 Eastern time. At this point, all we've really done is given back yesterday's end of the day rally. I don't really know where that rally came from. You can see these from time to time, particularly ahead of expiration week, which we're in right now. This Friday is a quarterly expiration. And so what we saw yesterday was just one of these mysterious rallies. Was it a buy program? Maybe, probably. Was it someone trying to get ahead of the Russell rebalance? Maybe. Was there a little bit of a pre-expiration effect in the sense that it kind of went a little bit longer and faster than it might have on a quiet day? Yeah, probably. So you put all these together, we turned a down day for the S&Ps and a slight up day for the NASDAQ into sort of a push to record highs at the close for the NDX, which I think had something to do with it. I think there was, a push, let's say, and once it got close to the old highs, some extra buying kicked in, and so today we're just basically giving back the last 10 or 15 minutes of yesterday. So I'm not reading too much into this. The market is, I think, able to look through some of these economic numbers because they're looking ahead to tomorrow's Fed meeting, and tomorrow's Fed meeting is, I think, going to be an interesting one. I think the Fed has to answer some tough questions. Do they still see inflation as being transitory? If so, why? Yes, we've seen many commodity prices come off their highs, which does bolster the idea that the commodity price aspect of it probably could be transitory. Lumber, which had gotten a ton of press, for going up to insane levels, has come back a bit. Commodity markets overshoot, and I think the Fed recognized that and didn't want to panic in the face of rising commodity prices. Quite frankly, I think they would have made it worse had they done so. But I think from the labor side, they're in an interesting situation. What we hear anecdotally, and what we see from the economic statistics, are people are coming back to work, but slowly, and employers are having difficult time filling available jobs. Now, as someone who's a free market person, I would argue that there's a phrase missing there, and they're having difficulty filling available jobs at the wages that they are willing to pay. That becomes an issue. Employers are reluctant to raise salaries. I understand it, but people want a better life for themselves, and so if you can get more money out of the whole procedure, of course you're going to try for it. The difference is a lot of the companies are trying to lure people with signing bonuses, other incentives, and that's the kind of thing that is not that can be considered transitory, right? If I'm paying whatever the prevailing wage was, and I now give $1,000 bonus to get a new employee in the door, there is a certain lack of productivity there because it does take a new employee time to get up and running, and learn all the procedures and corporate culture, if there is any, et cetera. Even at a hourly job, there's still procedures and practices that you have to know. And so if I pay $1,000 to someone to show up, okay, that's fine. It doesn't change the wages. But if I have to raise the wages across the board, a couple dollars an hour, first of all, if I'm raising them for new employees, the existing employees are going to want to raise. And secondly, salaries are sticky. They tend to ratchet up and not come back down. That is not transitory inflation. How does that how does that work with the Fed's full employment mandate? Is there a mandate, let's say, to try to do full employment at higher wages? Do you sacrifice some of the absolute numbers for higher wage numbers? There have been a lot more retirements and people have left the workforce. How do you account for that? These are questions the Fed has to answer tomorrow. If it were me, if I were one of the reporters, for Chairman Powell tomorrow, the question I would ask would be, how do you explain your continued monetary accommodation at the same time that you see reverse repo facility being utilized in a manner that it never has before? It's a record rate, and it's actually been growing to record use numbers more or less on a consistent basis. You would typically see spikes into the end of the month, end of the quarter, end of the year, which is when bank balance sheets. Banks are trying to tidy up their balance sheets, and they may have some excess cash, and Bank A has some excess cash, and Bank B doesn't necessarily want it, so they're going to so the depositor of last resort is the Federal Reserve. To me, I see what's going on now as the Fed is trying to fill up a monetary pool. And they've done a really good job. And at this point, the pool is largely full. And you're still running the hose on one side, but the pool is filling up, and you're actually running a pump on the other side to take water out. I know that's a crude analogy, but that's kind of what's going on, is the reverse repos are taking money out of the banking system. And so, to me, how long can you maintain this situation where you're pumping in money and you say we're not going to slow the rate of pumping, we're not going to turn off the pump, but meanwhile on the other side the pool's kind of overflowing and the swimmers are trying to take all the water out, take some of the water out with a pump on the other side. It doesn't make a ton of sense, and that's really the question that I would want to hear an answer to, and I think that's going to get into the tapering debate. If they don't answer either of these questions to the market's liking regarding labor, tapering, etc., you can get a bit of a pullback. We are, as I mentioned, we're at or near record highs on the major indices. That doesn't leave a lot of room for error. Last Fed meeting, we didn't see much of a move, but the prior two Fed meetings before that, we saw moves of 1.5% and 2.5% on the day after the meeting. A lot of times these things don't happen on the day of, they happen the day after. Because the traders do one thing and then the investors think it over overnight and do something else. So there's a lot to think about this week. It promises to be an active one. You're not seeing it now, but trust me, it does. There's at least the potential that it becomes a very active week. And we'll talk to you soon. Take care, everybody. Bye-bye.